If you raise prices on a meaningful cohort of goods in the U.S. economy, it is going to destroy demand. And structurally, if you destroy demand, that is generally the second and third order consequences of that are negative for the economy and negative for price growth in the economy.
What other indicators point to you a weakening economy?
I mean, the interesting thing right now is everything.
U.S. markets are once again flirting with all-time highs. The S&P is closing today at 6,100 points. The NASDAQ is up to 20,300 points. We're talking about the future of the markets and economic growth with Bob Elliott, CEO and CIO of Unlimited. Welcome back to the show, Bob. Interesting time.
Thanks so much for having me.
Yeah, thanks for coming back. Interesting times we live in. I was just talking to you offline right now as we're speaking today on the 27th. Feels rather calm for the markets, with the stock market up about 70 basis points this morning. Gold's down 2%. Bitcoin is flat. It just feels calm. And there's so much uncertainty surrounding policy, geopolitics, and macroeconomic data, which we'll talk about in just a minute. But it just feels like markets are either discounting all that, or there's just some other bullish sentiment that's even stronger, and prevailing sentiment is winning. So before we get into the data itself, how would you evaluate sentiment right now?
I think in general, people are trying to look through as much of the challenges as they possibly can. And I think part of that is from the perspective of, the challenges that has faced, particularly the U.S. economy, but also the global economy over the course of the last couple of years, never seem to have materialized in a way that has created a slowdown. And so in a lot of ways, folks, I think, are conditioned that, the folks who are raising questions about what's going on are going to be proven wrong, and therefore you're better off buying the dip or any dips that you see and pushing markets higher as a function of that. I think that another issue, which is an important one as we sort of push here into the end of the first half of the year, is, frankly, a number of asset managers who de-risked around the tariff-related challenges in the markets, a few months ago, are trying to catch up to what's going on, both in their positioning and in terms of their returns. And so a lot of probably what we're seeing here in the last sort of push here in terms of equities is a set of folks positioning for quarter end in order to, have books that don't look off sides in terms of how the markets have performed through the first half of the year.
What's your outlook for the S&P before we get into the data itself? Is this the end of the rally, or is this only the beginning?
I think that the challenge, and if you just look back through time, is the single best indicator of what happens to the S&P 500 over time from a macro perspective is how growth comes in relative to how it's priced. And the reality is, back in 22 and 23 and 24, I was actually much more positive on the economy than what was priced in to stocks. And stocks, obviously, in late 22 through late 24 did very well, because growth continued to hold up relative to what was expected. I think we're seeing a pretty different circumstance right now, which is expectations for future growth that are priced in the stock market are very high and remain very high. And it makes sense. Prices are basically at all-time highs. But at the same time, you're seeing a pretty rapid deceleration in the actual economic stats. And that sort of divergence suggests that we might be seeing a season of disappointment ahead when it comes to how the economy will perform relative to expectations.
Personal income was released today, the data from the BEA. Personal income decreased $109.6 billion, 0.4% on the monthly rate. Personal consumption expenditures decreased $29.3 billion, 0.1%. Personal outlays, the sum of PCE, interest payments, and personal current transfer payments decreased about $27.6 billion. I wonder how much was this just due to slightly lower inflation data. And so the actual volume of goods consumed didn't really change much. What do you think?
Well, the real PCE numbers were pretty weak in terms of the consumption numbers, I should say, were pretty weak. And part of that is because we continue to see elevated price pressures in the economy. And so, for instance, the report that was released today showed 2.7% core PCE growth over the course of the last year, higher than expectations. and in part reflecting the revisions that we saw yesterday from the finalized GDP report, which pushed core PCE numbers higher. If you just look at the economy and you look at household demand, which of course, just when the thing that drives the overall economy is household demand. Other stuff's pretty marginal on overall. And that has been household demand has been negative on a real basis since the beginning of the year. That is a pretty unusual event, given that sort of the trend growth in household demand has been about 2 to 2.5% over the last couple of years. And so what we're seeing actually with the most recent data is something that's even weaker than what we've seen since the beginning of the year.
However, the labor market's still looking rather strong, especially if you consider that the unemployment rate hasn't ticked up considerably. And Jerome Powell has stated this several times, especially during his last FOMC conference. And so, even though maybe on the surface, real wages are not growing, in fact, they're falling on a month-to-month basis, the labor market is still relatively solid, and slack is not there. Can you evaluate that?
Yeah, I think I just separate two different points. There's a question of slack in the labor market, which is what the Fed is focused on. And then there's a question of what's overall growth rate of the labor market. And so when it comes to slack, it's definitely true that the combination of, what is relatively modest employment growth combined with very slow, significant slowing of labor supply has meant that the unemployment rate has been relatively stable. I mean, it's been at 4.2% basically for the last year. But on terms of the overall growth rate, that's where we're seeing a meaningful deceleration. And so if you take a couple of different measures, while people focus on, for instance, payrolls, the number, which have held up to some extent, typically those reports are before adjustments, and those adjustments have generally been quite negative over the course of the last couple of years, and you expect them to continue to be so. So once you take that into consideration, you're looking at payroll growth around zero. The household survey, which is a different angle of employment, has actually been negative since the beginning of the year. And the ADP report, which is just a totally independent triangulation of labor markets, has shown a significant deceleration to close to zero growth in the most recent months as well. And so all of those numbers, they point to a pretty weak scenario, with the even more timely numbers like continuing claims ticking up relatively meaningfully in the last few weeks, suggesting that hiring in the U.S. economy has really come to a standstill.
Okay, this is I'd like to ask you about why real personal income fell. So this is the BEA report. It says here the decrease in current dollar personal income may primarily reflect the decreases in government and social benefits to persons in farm proprietors' income that were partly offset by an increase in compensation. The $29.3 billion decrease in current dollar PCE in May reflected a decrease of $49 billion in spending on goods that was partly offset by an increase of $20 billion in spending for services. So the report is stating that some of this is due to government and social benefits going down, which is why personal income fell. Could it be that that's just the reason? Is that is there anything less benign than that?
Yeah, I mean there is some wonkiness. The numbers were actually quite a bit stronger than what you would have expected in the previous month and the previous couple of months because of a true up in social benefits for government employees like firefighters and teachers, et cetera. And so that's creating some short-term choppiness in those data, that is causing that noise. It's probably better when you're looking at that. I often like to look at wages and salaries because I think wage and salary growth is the actual income sitting in people's pockets that they can actually spend. And so when you look at something like that, what you've seen is, we've had a relatively important deceleration in wage and income growth, as labor markets have softened. Both wage growth has softened as well as employment growth has softened. And that adds up to something that looks, closer to sort of 4.5% nominal. If you look at that compared to, real PCE that's growing at, between roughly around 3%, that's not a great scenario for sort of the core spending power for households. And they're actually choosing to spend less than their wage growth right now, which is also a sign of concern in terms of their activity.
What do you think is contributing to this overall decrease in real wages?
Well, it really comes down to a softening of the labor markets, and while you've seen sort of labor supply match a slowing of labor demand, it doesn't mean that there isn't a slowing of labor demand. And I think in particular, what we're seeing since the beginning of the year, given all of the significant uncertainty in the market, is that hiring has really frozen. And so, while employers are keeping the workers that they have on payroll, in part because they paid the price of that during the post-COVID period when they had laid off a bunch of people, they're really not hiring anyone. And when they're not hiring anyone, that is really creating a challenge, right? Because in a lot of ways, your incremental wage growth is not determined much by the people who are currently employed. They're kind of takers of wage growth in many ways. It's really determined by the incremental new hires. They're really the leading aspect. And if there's very weak hiring, what that means is that wage pressures are also moderating significantly. So you sort of get a compounded effect of slower wage growth and also slower labor market growth.
Okay, wage growth slowing because hiring has frozen. Now, historically speaking, whenever we have a situation where hiring freezes, does that lead layoffs, or is there no correlation?
Typically slowing of hiring leads layoffs. If you go back and look at the 2008 cycle, hiring slowed ahead of the layoffs that eventually occurred. If you look at the 2000 cycle, you see the same thing. And that lead is usually something like 6 to 12 months in those past couple of cycles. And so, hiring slowed meaningfully, at last year to some extent, and we haven't yet seen a pickup in layoffs. I think, as I said, I think in part of that is a little bit of labor hoarding that's occurring in the market. But it probably won't be long if there are signs of slowing demand, which is really what businesses respond to, right? Are they seeing sales or are they not seeing sales? That's when you could start to see layoffs start to pick up because of a recognition that the demand environment's a lot weaker for them than it had been.
Could we say that the hiring has slowed down because of uncertainty surrounding trade and tariffs, or do you think it would have been slowing down anyway, regardless of trade policy?
Yeah, I think we're sort of it's a little challenging in this environment because there's sort of two intersecting things going on in the U.S. economy, which is one, we are in a late cycle environment where high interest rates are sort of very slowly eroding the economic expansion, and that's very typical late cycle dynamics. The thing that and were we not having all this uncertainty about policy, probably that would be a marginal impact that wouldn't really be noticed. But the challenge is we're having this intersection of the late cycle dynamic with the policy uncertainty, which was really causing businesses to essentially freeze up. Basically other than AI spending, they're basically totally frozen in terms of their activity, whether it's incremental new plant and equipment investment, whether it's hiring. We're really seeing still a fair amount of slow activity or frozen activity, while what's going to happen with policy is remains uncertain here.
Perfect. Let's talk about some assets that moved today, and were a lot this week. So I mentioned the stock market was up, to new all-time highs or touching previous all-time highs. Gold in particular has been having difficulty breaking above its previous high above $3,400. Just today, it's down 1.8%. Is it what's going on? Before I suggest any of my own theories, I'd like to get your take on what's happening with gold.
Well, I think gold sits as both a contra currency to dollar devaluation, sort of a boomer Bitcoin, and it also serves as a geopolitical hedge. And obviously, some of the geopolitical risks that we've seen have moderated over the course of the last week or two, particularly the conflict in the Middle East, which is taking some life out of the gold market to some extent. Some of the premium out of that, and the reality on the other side is the dollar in a lot of ways is like the dollar, meaning the dollar versus other developed world exchange rates, is kind of catching up to where gold is. Gold's kind of led the charge. And I think when you look at what's going on in the market, there's sort of a rotation now that's that's emerging, sort of moving away from gold as the sort of core contra dollar bet to looking at and to be clear, Bitcoin to some extent too, and looking more at just dollar versus developed crosses as the primary way in which that's going. And that, while gold and Bitcoin are basically at highs or close to highs, um, the dollar against developed world currencies is at all-time highs, or not that far off of all-time highs, despite the fact that it's fallen to some extent to start the year. And so, what's the cheap trade against the dollar? It really is on the currency side much more than it is on gold and Bitcoin right now.
Do you think gold has erased some of its geopolitical war premium? Which,
Yeah,
yeah,
yeah, for sure. Part of the gold has reliably traded positively in response to rising geopolitical tensions, and you saw the same dynamic play out over the course of the last couple of weeks, and so that's certainly part of it. And you probably got a few percent uh, from that geopolitical risk premium that was in there that is unwinding at this point. Not a huge move because of it, but certainly something that has been a bit of a drag.
right. Well, what is gold signaling right now with prices going down? Is it signaling lower inflation, less war, all of the above, something else?
I think it's mostly unwinding of the geopolitical hedge because if you look at what's going on over on the dollar side, it's not like the fiat money devaluation story, and particularly the dollar devaluation story is off the table. It's much more it's much more sort of isolated to gold in particular in terms of the price action that we're seeing.
Let's talk about the dollar itself. So since the beginning of the year, the dollar's been sliding considerably. We'll put a chart up on the screen of the dollar for the audience here. But I'm wondering what you think is going to happen next now that the dollar has already declined so far since January. And there seems to be this unwinding, like you said, of tensions between China and the US when it comes to trade. What's your outlook on the dollar?
Yeah, well, I think we've got a long way to go in terms of adjusting the dollar to essentially where it's closer to being a fair value. Two main drivers that are going on there. At one level, or an important driver that pushed the dollar basically to secular highs, multi-decade highs, was the flood of demand from foreigners into U.S. assets, particularly foreign asset managers in places like Europe and Japan. And those asset managers have started to question whether it makes sense for them to be essentially like all in on US stocks, massively overweight relative to what would be a more neutral or diversified position. And what we're seeing is the slow erosion, the slow shifting back. And they don't have to even sell US assets. They can just go from buying a lot of US assets. At one point, the US was getting 70 cents of every dollar of global capital flows into financial assets. Even going to 60 or 50 of that would be a big drag on the dollar. And that's an important story. And it's important to recognize that those asset managers, their position shifts play out over the course of years. They're slow moving. And so that can be a persistent pressure on the dollar, just like it was a persistent support for almost 15 years post GFC. The other thing I'd say is when it comes to the trade dynamics, what the administration is doing is creating a set of policies that are, whether explicitly or implicitly, intended to be dollar negative. And so whether it's the shortening of duration in the bond portfolio, or making efforts, or at least threatening to engage in taxation of foreign entities that they don't like who are holding U.S. assets, or various efforts at breaking ties from an economic perspective. These are all various strategies that are eroding sort of the global interest in the dollar as as sort of the primacy, the dollar's primacy in terms of global financial assets. That doesn't mean that the dollar's reserve currency is going away. It doesn't mean that it's going to be a total disaster and an inflationary shock in the US. It just means that we're likely to see, in the same way the dollar got a lot of the benefit over the course of the last 15 years, we're likely entering a longer term phase where the dollar sees a lot of, it is sort of getting the short end of the stick in terms of, global investment flows.
So, just on a trading perspective here, the dollar plunged to a 3-year low today. From a trade, or as a trade, would you consider buying this at buying the dollar right now at current levels relative to another pair trade or another pair currency cross rather?
Well, I think when you're looking at it relative to things like European and European currencies, to be clear, the current level of currency already reflects the significant easing that has occurred. When you're looking at the U.S. and you see weakening economic conditions that have yet to be reflected in whether it's equity prices or bond yields or short rates, um, that's generally a pretty good trade to hold, you know, the euro, say, relative to the dollar. If you're looking for places to maybe go long the dollar, probably the Canadian dollar looks like one of the more attractive opportunities where, the Canadian dollar has rallied in the face of truly terrible economic conditions and the need for a rapid shift to easing, much more easing to stabilize the economy. And so, you know, folks here are probably not carefully navigating all of the different developed world crosses, but the dollar being soft relative to European currencies, or the yen looks like a good trade. The dollar long relative to the Canadian dollar also looks like a good trade at this point.
How do you feel about the strength of the dollar in the future if the Trump administration wants to, I guess, pull back a little bit away from European affairs, which is to say, they want Europe to take care of their own security problems, or at least pay more and rely less on U.S. security? Is there a relationship between that dynamic, which would play out over several years, and the overall strength of the dollar and demand for dollars from Europe, especially?
Well, I think the geopolitical dynamics there are one where uh, the currencies are likely to trade based upon the macroeconomic forces, and in particular, the shift in the demand that Europeans engage in greater, essentially, fiscal expansion given their conservative fiscal positions, is generally a growth positive story and also would support bond yields that are depressed in Europe, both of which would be a net positive relative to the US. And so, in a lot of ways, what I'd say is that the administration's efforts to basically push Europeans into taking a more proactive and expansionary fiscal stance. It happens to be through military spending, but places like Germany are broadening that out, is actually very supportive to their currencies as it'll attract capital, mostly their own capital that had mostly been accumulated in the US back on shore, or incrementally back on shore, which will support their which will support their currency and likely their equity markets relative to US assets.
Okay. Is there a fear from your part, at least, of inflation returning significantly? I'm talking about in the U.S. in the wake of tariffs. And I mentioned this because, like in 2018, when Trump announced tariffs in term one, the CPI data is just not yet reflecting any surge in pricing from tariffs. So maybe this is a nothing burger in terms of concern. What do you think?
Yeah, I think that's a good question. One of the things that is a challenge here in terms of seeing the tariff flow through is it's actually taken time for the government to actually ramp up the tariff collection. While we see charts where tariff collections are rising, just for context, if you go back to, say, April, where tariff policy was at its extreme, the government only collected about 25% of the stated policy tariffs that were in place. In June, it looks like it's closer to 60%. That's ramping up. It shouldn't be a surprise. Like, you're trying to get the government to collect duties from the greatest tariff hike in the history of modern man. And so, it would make sense that it would take some time for that ramp up in collections to occur. And so the important consequence of that is that given the fact that goods, good supply chains are in the 3 to 6 month range, we're probably not really seeing yet the effect of the tariffs on the actual prices of goods on the shelf, given the combination of that supply chain time combined with the fact that the tariff collection rate has been delayed. And so this is probably, a later second half story before we can really make a good case or a good judgment about whether or not higher tariffs is actually flowing through to domestic prices. That being said, the idea that there's going to, the idea that there's going to be sort of a more significant, wage spiral or inflationary spiral here, is probably not going to happen. And so, it's almost certainly not going to happen. We're talking about 50 or 100 basis points on core PCE at the most in terms of the flow through of the tariffs.
Right. And the fact that real wages have been softer in terms of growth. Now, does that feed into inflation data? In other words, the theory that wages somehow impact the overall CPI, do you buy into that theory?
Well, I think ultimately the sort of core thesis that nominal spending for households in particular is driven mostly by nominal wage growth. And so it's challenging to have high nominal spending, which drives inflation in an environment of soft nominal wage growth. I mostly agree with that. And it's the reason why, in general, that we're not going to see the sort of inflationary spikes that we saw, back in 2022, et cetera. Much more likely what we're going to see is demand destruction, which is the goods that are tariffed are going to have higher prices. And we're seeing that a little bit, but that's going to take some time to flow through. Given the fact that they have higher prices and, a lot of those things are staples, people will essentially have to spend more on those products and spend less and have less real spending on other products. And the consequence of that will be negative real demand. And so I think the thing that's essentially much more, whether it's CPI or PCE, core PCE, positive or negative. I mean, it's probably on the margin just because how it's measured. It's probably core PCE positive. But the real thing that we know, big picture, is that it's definitely demand destructive. If you raise prices on a meaningful cohort of goods in the U.S. economy, it is going to destroy demand. And structurally, if you destroy demand, that is generally the second and third order consequences of that are negative for the economy and negative for price growth in the economy.
What needs to happen for consumer buying power to return?
Well, it really comes down to two basic things. Either you got to get some wage growth going on here, and there is a story that by constricting labor supply, you may be able to create higher wages for domestic folks. And in certain pockets of the market, you're seeing that a little bit, but that's tough in an environment of weak overall demand. Or you're going to have to get households to save. And for a while there, that wasn't very hard. When stocks were going up 20% a year, it was pretty easy to get households to basically spend entirely out of their income because their 401ks were going up and their house prices were going up and they needed to, and they were fine not saving incrementally because they were getting asset price appreciation. That's a lot more challenging in this environment where you've got, asset prices, which have basically been flat for, 9 months. And we're seeing that in the savings rate, which is the savings rate ticking up as a function of that. And so you got to figure out a way, maybe it's lower interest rates, meaningfully lower interest rates to stimulate borrowing, or you got to get asset prices to get back on a long-term upward trend in order to get the spending to occur.
You think protectionist policies would help with raising domestic wages, especially if the theory is that manufacturing is brought back to the U.S.?
Well, I think the time frames of that are important to consider, which is that it takes like 5 years to build a factory, so it's not like all of a sudden we're going to have a surge in manufacturing employment. You don't see a surge in manufacturing employment, despite the fact that tariffs have certainly been illustrated for a while and have been in place for months now as well. And so that's like maybe over the course of 5 years, you get that story playing out that's supportive to wages, particularly wages for lower skilled workers. The real thing that has the hope, to the extent that you think about it that way, of supporting wages in the short term is constricting immigration. We went from a point where in 2024, 2.4 million workers got worker permits, immigrants got worker permits in the U.S. economy, and the administration so far has repealed about 500,000 permits this year, and is seeking to repeal another 500,000 permits through the rest of the year. So that's a 3.5 million uh, change per year change in terms of labor supply. And so what that means is, if you have the demand and you're a company, you got to meet that demand. It's a lot harder today, particularly with lower skilled workers, to find that labor supply. Probably not as extreme as those numbers, since of course some of those folks are now working under the table. But that is a challenge, and that's probably the most likely short-term effect. And we're seeing that a little bit, like in truck drivers and construction workers and stuff like that. We're seeing some of those effects already starting to play out.
You mentioned to me offline that overall macro conditions are weakening. We talked a lot about the labor market today. What other indicators point to you a weakening economy?
I mean, the interesting thing right now is everything. And so if you look at demand, which we talked about, if you look at labor markets, if you look at construction activity, which is an important component, has been an important component of keeping the economy afloat, or other things uh, you know, like manufacturing, industrial production, etc. Like production, housing, labor, and demand. Those are sort of the core components of the U.S. economy, and basically all of those are slowing meaningfully. And I think there's kind of a question like, we saw a big deterioration in the soft data at the core, at the start of the year. And the question was kind of like, was that going to flow through to the deterioration of hard data? And it's interesting that while the soft data has improved to some extent over the course of the last couple of months, the hard data has continued to decelerate. And, a lot of different ways that you can slice up the economy and look at growth, but probably good comprehensive measures of growth, sort of from a bottoms up individual stat perspective, are looking at something that looks more like 0 to 1% right now, which is meaningfully slower than what we saw in 2024.
Okay, so it sounds a lot like this is uh 2021 all over again when we had weekly economic data, but the markets at the time, excuse me, the markets at the time were still ripping higher. So maybe there's a disconnect now between, or 2020 rather, even more pronounced than that. As an example, is 2020 when COVID happened, and and limited QE was announced. The Fed printed money, and so all markets, gold, stocks, Bitcoin, risk assets, safe havens alike, ripped higher, bonds ripped higher, but the economy was really, really weak. So that was an extreme example, but if your theory is correct that the economy is weakening now, that's certainly what it looks like, a disconnect between the real economy and markets. And so what does that mean for investors?
Yeah, I mean, it reminds me personally of the 07-08 period. Now, I'm not saying we're going into a financial crisis, and the underlying drivers are different in terms of what's going on and magnitudes. But that idea of, if you go back and look at the history, the stats, meaning like the actual real economy and data, suggested recession as early as the fourth quarter of 2007. But stocks continued to basically be at highs. They peaked in 2007, but they continued to be relatively strong through, as late as May, and that was just a disconnect, right? There was a lot of expectations that there would be decoupling occurring, that, something like subprime would be contained, which it obviously wasn't. But I think that sort of psychological dynamic is a very normal dynamic, particularly as you get to late cycle. Look, for years, people were conditioned that the economy was going to be weak, and it ended up massively surprising in terms of how strong it was, particularly in relation to the elevated interest rates. And now, in many ways, people are just expecting that, well, because the economy has been strong, it will continue to be strong, and are pricing that into asset markets, essentially right at the time when we're starting to see a meaningful deceleration across pretty much every indicator on the U.S. economy.
Right. So in terms of allocation then and positioning, what does that mean practically speaking?
Well, I mean, it's an environment that a lot of people have eschewed bonds, particularly over the last couple of years, and it's a time when bonds can provide meaningful diversification. So, buying bonds particularly relative to equities, looking for foreign stocks, and also looking for assets that maybe are pro growth but have better valuations if you want still some of that pro growth bias. So things like high yield spreads, which look basically closer to fair value given their fundamentals relative to buying, US equity indices at all-time highs with very elevated expectations.
Here is a tweet that you made about the Fed, dated June 18th. The Fed has no reason to cut based on the data that matters. The risk of inflationary pressures ahead from both tariffs and rising oil prices due to the Middle East conflict will only further solidify their desire to keep rates steady for longer than most expect. Okay. This was posted before there was some de-escalation in the Middle East. So on the Middle East front, do you still hold that view? And second, overall, then, what do you think the Fed is going to do?
Well, I think um, the Fed makes policy based upon the data that it sees and not in general the predictions that it makes. And it just very simply, if you look at core PCE is, essentially 2.7% on a year over year basis, which is 70 basis points above their target. And the unemployment rate's at 4.2% and has roughly been there over the course of the last year. The Fed shouldn't do anything. And all the models, if you just take a simple Taylor rule or all the sort of derivatives of the Taylor rule, they'd say current rates are roughly right. And so whether you like it or not, the data supports the Fed being on pause and has supported the Fed being on pause, through the first half of this year. And the uncertainties suggest that, the Fed will continue to be very, will be cautious in terms of delivering easing until they can gain confidence that, they're not going to see an inflationary problem coming from the tariffs. And so, the reality is, while I strongly do believe that the economy is decelerating, the things that the Fed cares about are not yet weakening enough for them to shift towards an easing stance, and the risks are skewed to the upside related to inflation. And so that means essentially one of the worst combinations, which is the Fed will likely not deliver any monetary easing just at a time when the economy is slipping, particularly relative to the high expectations in things like stock markets.
Okay. Can we expect a rate cut this year?
I mean, maybe they cut once, but it's not, this is not, I think a lot of people really popped up on this idea that there's going to be, a shadow Fed chair and that the Fed's going to be pushed into easing materially. Like, I'd probably describe it this way. If we get anything more than roughly, 0 or 1 cuts, it's the type of conditions that you sure don't want to be holding equities in.
Perfect. Thank you very much for your update. Appreciate it. Where can we learn more from you, Bob?
Yeah, thanks so much for having me. If folks are interested in following on my sort of ongoing macro thoughts, you can find me on all the various social media platforms, Twitter, LinkedIn, YouTube, even TikTok, under the Bobby Unlimited handle. And also for those who want to sort of go deeper in terms of these day-to-day stats, macro stats, and what they mean for the economy and markets, you can check out my new Substack. It's called Non-Consensus. And if you just Google Bob Elliott Non-Consensus, you'll find it.
Thank you. We'll put the links down below. Speak again soon, Bob. Take care for now.
Thanks so much for having me.
Thank you for watching. Don't forget to like and subscribe.